Alright, so in this video it's going to be pretty much tying everything together. So I'm going to be going down how I got in on this trade and caught this whole move right here from here to here. So pretty much it's as simple as we're going to start off on the monthly time frame. So anytime I always analyze the market, I always look at the monthly time frame. As you can see here, we did have a bullish engulfing pattern showing that buyers were able to push the market up towards this area and completely pass it. So as you can see, lots of buyers, lots of bullish momentum. So keeping that in mind, EMAs are crossed red over blue, indicating that there's more seller volume in the market. And previously, this was a big fat buyer's exhaustion wick. So now, going on to the weekly time frame, I believe this candle was still forming at the time, but it did close bearish engulfing, as you could see here, meaning that sellers were able to get past this point here. So, but I'm also keeping in mind, week after week after week after week after week, buyers were getting just exhaustion. And as you can see, we ended up having a bearish engulfing candlestick. So now with the market gap, it looks kind of fucking retarded, but that's fine. Now going on to the daily time frame, we did have this kind of bearish variation pattern along with the area of resistance that has been rejected. As you can see, yellow is my area of resistance that was rejected. So keeping that in mind, now we're about to have a cross of EMAs is what it's looking like so far, but who knows. So pretty much, like I said again, we did have this bearish variation pattern. Now going on to the 4-hour time frame, we were still at an overall uptrend, but at the time that EMAs had crossed here, there was just buyer's exhaustion, shit ton of exhaustion everywhere. So just looking at that, EMAs did cross on H4, indicating that there's more sellers in the market, but at the time we were still in on an overall uptrend. Now going on to the hour time frame, the market did break structure once it got past our previous higher low point being here. So once the market actually broke this area of support, it broke our previous higher low point, meaning that it broke structure. As you can see, here's my point A, here's my point B. It broke 100%. As you can see, then it consolidated at in between 110, 120%, indicating that the trend is changing. EMAs were crossed at the time. That's why I did not have an entry all throughout here. I waited for a lower high point to be presented to me, and it was. So go from the previous high. So here's my previous high to our lower low. So I was having this glitch last time, but it's supposed to be at the bearish candle wick. So now, as you can see, at this point in time, the market had formed this area of exhaustion and kind of this bearish engulfing pattern with little seller's exhaustion towards the bottom. So every time something like that happens, I always mark it off. So now, since my main analyzation is off the hour, I'm going to break it down to M15 to look for structure points. As you can see, here we have an area of resistance that the market shouldn't have broken. So once the market did break this area and got past this area of resistance right here, I don't know why my trading view is so retarded. It's glitching out and it's actually getting me upset because it's interfering with my analyzations. But anyways, like I said, once buyers were actually able to push the market up towards this area, we started a counter trend making higher highs, higher lows, higher high, higher low, higher high, higher low. Since I'm not seeing too much detail here, I'm actually going to go to M5. So as you can see, now we could see our counter trend perfectly. So here's a higher high, here's a higher low point, here's a higher high, here's a higher low point, here's a higher high, here's a higher low point. So pretty much we do not want to enter the market until we have a bearish engulfing or a bearish variation pattern on the higher time frame, being the hour, and make sure that candle closes, and we have to wait for the break of structure on the smaller time frames so we can confirm that the market's actually going to go back down. So as you can see here, here's another higher low point. Here's a higher high point, higher low point, higher high point, higher low point, higher high point, higher low point, and then we formed a high. And then as you can see, the market did end up breaking structure once it got past this area, which was our previous higher low point right here. So you can see this was a higher low point. So pretty much we have to wait for a higher low point to be broken to actually enter and benefit off the market. So as you can see here, once EMAs crossed red over blue, indicating that there's more sellers momentum in the market, and the market actually broke structures. You can see over here, EMAs did cross red over blue, and we did break a previous area of support, but not a previous higher low point. So once the market actually came down, formed that bearish engulfing on the higher time frames, and it closed, it was confirmed, then obviously the market had already broken structure. So let's just really quickly write down a list of confirmations, right? We broke structure on the smaller time frames. EMAs crossed on smaller time frames. Now we have a bearish engulfing on the smaller time frames, on the higher time frame being the hour, and we have the EMAs, I'm pretty sure they were already crossed red over blue on the hour. Yeah, so it was still red over blue at this time on the hour time frame. So that's already 4 confirmations for a sell opportunity, right? So now pretty much we already have 4 confirmations. So all we have to do now is wait for an entry point. You know, we can have another confirmation, you know, buyer's exhaustion at the 50% area, at the 50% PRZ, as well as a rejection of 50% on fibs. So that's already 6 confirmations, I believe. So now pretty much went back up to M15. As you can see, we did have a nice bearish variation pattern here, as well as this bearish engulfing candlestick with a little seller's exhaustion towards the bottom. Same thing with this candlestick, a little exhaustion towards the bottom. Then we ended up pulling back. So once the market actually did pull back and we had this kind of bearish variation form, and we got past this previous bullish candle, I ended up having my first sell opportunity right here at this bearish candle. EMAs were already crossed, and I was like, all right, cool. So here's my first sell. So keep in mind that grab a short position. My stop loss was all the way up here at 110%, 75 pips away, and I was in on a 2 lot. My account can handle a 75 pip loss on a 2 lot. Just keep that in mind. And my take profit was down here at almost 90 pips away. So we have a risk of 75 pips, I believe that is. Oh no, my apologies. It's 112 pips and a reward of 90 pips. You know, not the best trade. Obviously the risk reward isn't there, but I did end up closing all the way down here once it started pulling back. So I ended up closing with a profit of 108 pips. So it was almost kind of like an even risk to reward ratio. So let's pull this all the way up to here. Now I ended up closing right there. So now how to actually do the risk management. So pretty much the most you should ever risk on your account is 25%. So that was in the range of the 25% that I was risking on my account. So pretty much whatever I do is once I have my fibs set to do the risk management, I can only risk 25% of the account. So if I have a $1,000 account, I can only risk $250 because that's 25% of $1,000. So now what normally I always do is I obviously grab my pip tool. Okay, this is 120 pips away, 23. So then I start setting off what lot sizes I could use depending on the, you know, how many pips I'm gonna be risking and what my account size is. So let's say if I had a $1,000 account, you know, let's leave it at if I had a $3,000 account, right? And I can only risk 25%. I can only risk 25% of the account. Okay, so it's as simple as you grab 3,000 and multiply it by 0.25, and that gives you $750. So I can only risk $750 at most. Right? This is why risk can be predetermined, but reward is unpredictable. So I can only risk $750, like I said. So we're keeping this in mind. Now, if the market decided to retrace off of 23.60, right? I have 127 pip stop loss, so I cannot throw a standard lot size here. The biggest lot size I could possibly throw is a 0.50, meaning that if my stop loss does get hit, that 120, I'll lose $600 flat. Okay, so now